Hey, everybody. Welcome to this Saturday, March 30th, 2024 edition of EarningsBeats Weekly Market Recap. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we try to go through, take a look at some of the important items that happened last week, and maybe give us some clues as to what we might expect next week. We did end the first quarter of 2024 last week, so now Monday we will begin our second quarter of the year. So it's going to be interesting to see how this second quarter evolves given the strength that we showed during the first quarter. It was one of the best quarters. Actually, I think it was the best first quarter on the S&P 500 since back sometime around the financial crisis. So it's been a number of years since we had a first quarter as strong as the one we just had. I'm going to go ahead and jump right into some of the charts. Where I want to start this week is with a couple of the economic reports that we saw that came out last week. And I don't know if you noticed or, I always like to try and pass along some things that I use that I think can be very useful in helping us take a look at the health of the market. Obviously, we can look at price action and we can look at some of the under the surface signals, but some of these economic reports also can be used, and some of them are contrarian. I'm going to show you two of them first as we get started today. So the first thing I like to follow, or one of the things I like to follow, is the consumer confidence. Most of the reports that you hear about consumer confidence are the Conference Board consumer confidence. I actually follow the OECD consumer confidence indicator for the US. And one thing I want to point out about this, it came in with a reading on I think the last reading that we saw was actually 97.13. But if you take a look at where these bottoms are, you would think when consumer confidence is really bad, that means it's going to be awful for the stock market, but it actually means consumers are feeling horrible, and that usually coincides with market bottoms. So you get these readings that seem horrible, and a lot of folks believe that that means that the market is going to start really tanking to the downside when it actually what normally happens is we bottom. So I wanted to show you this chart. This goes back 50 years. And I just want to point out when we get down below 100, actually when we get down below about 98 on this and you start seeing these major lows that print, if you look, first of all, we had a big major low in 1975. If you recall, 1973 and 1974, one of the worst bear markets that we had. So at the end of that, we had low consumer confidence. 1980, remember inflation going through the roof? We had interest rates jumping, and 1980 was a time when we were at a fairly significant bottom in the market. And again, that occurred with low consumer confidence. 1990, you can see we dipped down here below 98 on this particular chart. And that was during the Gulf War, Persian Gulf War. We had a recession, and right at the bottom, or right near the bottom of the market, was when we printed this low consumer confidence reading. 2008, 2009, there's your consumer confidence reading. Market bottoms, almost exactly as confidence bottoms. 2011, remember we had that one dip went back. It was probably close to a 20% drop. And right when that bottomed, so too did consumer confidence. 2022, if you want to kind of get in my head, which may not be a great idea sometimes, but when I called the market bottom back on, I think it was June 17th, 2022, this was one of the reasons, consumer confidence was one of the reasons why I called that bottom. And if you look, once again, this reading was down at one of the lowest levels we'd seen in 50 years. And it coincided almost perfectly with that June low. Well, it did coincide with the June low, but we ended up going down just slightly below that afterwards. But the point here is that when consumer confidence is low, that tends to be when the stock market bottoms. So right now we're not at a low, but our consumer confidence still remains fairly low down here near 97. Which is why I think the stock market still has room. This is just one signal. So I don't just look at one signal and try to make a determination on what the market's going to do. I like to put all the clues together. But this is one that's pretty important. The flip side is when you get high confidence readings. I mean, if you look, the highest reading here, 103, occurred at the beginning of 2000. That was the start of a 12 to 13-year secular bear market. So when you start getting these readings when everyone's confident, that usually means that look out below kind of a thing. Things aren't going to get any better. They're already rosy and consumers feel great about everything. That's when you need to be careful about the market. So if you go back and you take a look at these tops, we had a top here. This was in 1977, but again, those mid 70s when we had a lot of issues in the market. This was after we had gotten a rebound. So I think maybe confidence was picking back up again. And then of course we had one more big move down. The mid 1980s, I guess, we did have the 87 crash. But really when we started to break down on this from a top was in 1990 as we headed into that Persian Gulf War, made that low. Then again, back up to the high. First, there was a high in 1998. If you remember, there was a short-lived cyclical bear market in 1998 over the middle part of the year, the summer. And so you can see this move down kind of coincided with this low in 1998. And then, of course, back to the high in 2000. That was the top in the market. If you look at 2007, when we were topping, we were back at 101 there. And then more recently, the trade war, right before the trade war, we were up at 101.5. Before the pandemic, we were sitting at 101.7. So there's just been, it always seems like this serves as a great contrarian indicator. So I just want to point that out. And again, make sure that you don't misconstrue when these signals come out. Just because people are really confident and thinking good, that a lot of times is the top. And when folks think that couldn't get any worse, that's normally when you're at the bottom. Moving on to the University of Michigan Consumer Sentiment. This is a report that came out last week, and it came in at 79.4, which is kind of in the middle of the range over the last 50 years. But we go back to 1978, and again, the bottom when the consumer sentiment is at its worst, that was basically the beginning of a 20-year secular bull market. And then when we get overly confident or, consumer sentiment is at its highest, again, when was it at its highest? Year 2000. So year 2000, we topped, came back down. If you look at the lows, 1980 was one of the lows. How about 2008, early 2009, 2011? And here was the biggest drop of all, right at the middle of 2022. When I called that bear market bottom. So we're in the middle right now. I think sentiment, if we start getting up into that 90, 95, even 100 range, I don't know that we'll get back up to where we were in year 2000. That was one of the highest readings that we've seen. But clearly anything above 90 is when you maybe start thinking about that, is a top near. Now you want to see other corroborating signs, though. You don't want to just act out when you see one signal reach a certain level. But when you start putting a lot of different signals together that are all telling you the same thing, that's when you can have some issues. All right, let's move on. I want to talk about the recap. So those were a couple economic reports that came out last week. But let's take a look at the how our major indices did for the week. So the Dow Jones Transportation Average was our best performing area, gaining 1.3%. The Russell 2000 Small Cap Index was second, gaining 1.13%. Then we had mid caps gaining 1.1%. S&P just barely up 0.25%. Dow Jones relatively flat. And the laggard last week was the NASDAQ 100. So this is kind of flipped from what we had expected. So a couple of areas that I really want to touch on, and I'll get to those in just a couple minutes, is number one, the transportation group. And then also we want to talk about small caps. Those were two key areas that I think could be signaling some things as we go forward, and we need to be aware of it. But let's take a look at sectors first. So what happened in the sectors last week? Look at the top 7 sectors. Actually, top 8 sectors. Top 8 sectors for the week. Do you see technology, communication services, or consumer discretionary in there anywhere? Nope. They're all at the bottom. So if you're looking for where the weakness was, it was all the aggressive groups. Now, one thing that I talk about, and I'm not just giving you hindsight, I was talking about it back in the middle of this quarter, quarter one. First half of the first quarter tends to be much more bullish, much more growth oriented. Second half of the first quarter tends to be a little bit more difficult sledding for bulls trying to carry the market to the upside. And we tend to see more rotation into defensive areas or value oriented areas. It's exactly what we're seeing. History continues to repeat itself in the stock market. You need to be aware of it. First half of every calendar quarter, other than the fourth quarter, first, second, and third quarters, the first half of the quarter just crushes the second half of the quarter in terms of performance. That dates back to 1950 on the S&P 500. That's not just what's happened in the last couple of years. That's what routinely happens in the stock market. Stock market, you get a lot of buying as you head into earnings season, a lot of anticipation. Earnings generally come in much stronger than expected. Stocks continue to perform well. You get toward the end of earnings season, which is right at about the middle part of the quarter, and then all of a sudden it's kind of like a sell on the news, or at least a go sideways on the news. We don't tend to see a lot of big moves during the second half of quarters, again, with the exception being the fourth quarter. Both first half and second half, fourth quarter tend to be strong. So I'm only talking about quarters 1 through 3. All right, so let's take a look at the transports. So here's the transport index. And you can see coming up, trying to get through key overhead resistance. This is a daily chart, and this is going back into December. The high here was set around 16.2. February, high at 16.2. Here a week ago, high at 16.2. And on Friday, we just closed at 16.2, 16.211. Trying to break out, but there's one difference this time. Each of these others, we went down and went through the moving averages, or at least through the 20-day moving average. Did it there, did it here, did it here. This time we went up, came back down and held above the 20-day moving average, and then moved higher. And in doing so, it's starting to look more like an uptrend. Now, of course, we may fail again at 16.2, and we might go right back down below the moving averages. And if we do, then I'm going to retract all this. I'm going to say, okay, we're back in the sideways consolidation. But for now, I'm assuming this goes higher. And I'm assuming it because the moving averages are now starting to turn up. And instead of the PPO sitting on the zero line, we now are starting to see momentum pick up. So this is the highest the PPO has been now for at least the last 6 weeks or so on transports. And we're showing this sign of bouncing off the 20 and moving higher. Now I'm going to show you a weekly chart on here. And I'm going to go back, I don't know, maybe 10 years. Again, transportation index, but you can see sideways or even downtrend, we break out, we go higher. Sideways, broke down during the pandemic, finally got out, and we went higher. Here we've been going sideways to down. Kind of, I'm not saying we're broken out because we keep going back down below the moving averages, but over the course of the last 5 or 6 months, we've been holding this rising 20-week moving average. So I think the weekly chart is setting up on the transports, and so too is the daily chart. If we have a good week ahead in transports, there's a good chance that we're going to see continuing movement as we go throughout the second quarter to the upside, in my opinion. So let's take a look at some individual stocks within the transports that are helping to push prices higher. So here is Alaska Air Group, sideways consolidation off a downtrend, just broke out, volume picking up. I'm going to try to go through these pretty quick. CSX, a railroad, nice move to the upside, had a little bit of a long tail there to the upside, came back down, moved back below the moving averages, and now we've come right back up through the moving average and through gap resistance. Looks like CSX trying to turn back up with the PPO at the center line. If we step back on CSX and look at a longer term chart, I think it's important because here you can see we were struggling to get through about $36.75 to around $37. We did that in February. We made that breakout, went all the way to 40. And now look at this pullback and the hammer that we established for last week, going down, testing or almost testing that rising 20-week moving average, and then coming back up and closing above that prior resistance, which is now support. Good action there. How about Delta Airlines? Delta Airlines, after sideways consolidating for a while, really strong last couple of weeks. Seems like it's poised to take on the high from back in July, which was over 49. That's what we're looking for here. How about FedEx Corp, FDX, gapping up with earnings, clearing the mid-December high? Very, very solid action. Looks like this one wants higher as well. JBHT, this was a downtrend line, failing at that 20-day moving average for the last, 4 or 5 weeks. And in the process, you can see a lot of these intraday tails testing the 20, not able to get through it. Friday, we got through it. I don't know if it leads to more strength or not, but it's the first time we've seen that now in over a month. Next up, JetBlue. JetBlue, look at these equal highs up here around $7.50. Rising low, slightly rising low. Looks to me like off an uptrend, we have an ascending triangle. Either way, whether you call it ascending triangle, sideways consolidation, it's a triple top. Breakout above 750 would be bullish here. KEX, this is Kirby Corp. After finally pushing through the September high over here in late February, we pulled back, tested that high, and now we've turned up again. PPO looks great. Volume trends are strong. KEX, I should say, looking pretty good here. Ryder, sideways consolidation for a while. End of last week, just broke out. And the last one I have for transports is UAL. Look at this break above the late February high. Went back, put in a nice hammer on the 20-day moving average, and we break out again. More and more of these transports are looking better and better. I'm going to go into the IWM because I think that's another significant area that we need to be addressing and take a look at. But before I do that, I want to just make sure everyone is aware. On Monday, we are having a free educational event on candlesticks. If you want to learn more about candlesticks, how I use them in my trading, you need to sign up for this event. It is a free event, but you're going to need to start a 30-day free trial to come in. So you do. The good news is you're going to see everything we have to offer at EarningsBeats. No commitment, simply a 30-day trial. And at the end of 30 days, you can decide what you want to do. But if you come in, you click on this banner there on our homepage, you can come back and take a look at everything that we're going to be offering over the next 4 weeks, the next 4 Mondays. All the events will start at 4:30 Eastern. So that's going to be April 1st, April 8th, April 15th, and April 22nd. And we're going to be covering some pretty interesting topics. Candlesticks, price volume. I'm going to show you what is important to me with price volume. It's the #1 indicator. So you really need to have a pretty good sense of understanding that particular topic. Then we're going to get into divergences and trading gaps. So we want to make sure that in order for you to learn all these things, we want you to kind of see how we approach it with our service. So it kind of makes sense that we piece all of this together. Also, I want to mention before we go back to the IWM and some of those small cap charts, please, if you like our approach to the market and you like this video, you like these recaps, please hit the like button and subscribe to our channel. We would love it. It helps us in non-financial support ways. It helps us with algorithms at YouTube and so forth, just to try and help us build our community. We want to reach more and more folks to tell them how they can better approach the stock market. Anyway, let's get back to the IWM. So here on the IWM, you can see, first of all, nice little cup right here off of this uptrend. We broke that. After breaking that, we put in another little cup with a handle. We broke that end of last week. So on the daily chart, I think it's pretty clear, 52-week high now on the IWM. We're not ready to hit all-time highs just yet, but for now, we'll take what we can get because small caps had been underperforming for quite a while. But we did get that breakout above 208.21, which I was looking for. And if we look at a weekly chart, There is no doubt in my mind the character on this chart has changed considerably. Instead of downtrending or even sideways consolidating, where these moving averages provided us no support, no resistance, that was a trendless market. Here, we were trending lower, then we were going sideways, and now we are trending higher. Notice each time we pull back, the rising 20-week moving average is holding. That was not happening over the prior year, year and a half. We struggled every time we got up to either key price resistance or the moving averages. Now we're trending above them. So we got price action above the 20-week, the 20-week above the 50-week, and the weekly PPO continuing to accelerate to the upside. Really good action. So I'm going to give you now one of the charts that I like to follow. And again, if you sign up for the events, you're going to learn much, much more about the way we approach the market and a lot of the research that I do. But the IWM versus the QQQ, if we ignore gaps, and the way I do this is I only look at the relationship between the IWM and the QQQ from the opening bell to the closing bell. What happened overnight? And, if we're down $3 at the open, I don't care. It does not come into play. I want to know what is happening throughout the trading day, because that's when distribution and accumulation take place. You can't have either of those taking place at the opening bell because there's not enough liquidity. I sometimes you can go in and maybe there's a $200 stock or something. You try to sell 100 shares and you lose 60 cents because the bid and the ask are so far apart. Might be over $1 sometimes I've seen, but I try not to sell on a gap down for that very reason. I mean, it's manipulation. Normally you can get a better price in the afternoon. Anyway, this chart, if you look at it, the relationship between small caps and the QQQ, which have mostly been going lower for the last 11 years, notice we just broke, or we are on the verge of breaking, to the highest level that we've seen since back at the end of October, when this latest surge in equity prices began. So we're right about where we were then. We're not downtrending versus the QQQ any longer. It's telling me that rotation is taking place in the IWM. And in fact, over the last 2 months, that rotation has been pretty severe in favor of small caps since the beginning of February. And I'm going to show you on an RRG chart how powerful you can see it visually. But hold on, we're going to get to that in a minute. Also, next panel here is just the IWM versus the QQQ, including gaps. So there's no special user-defined index that I've had to create to do this. This is simply just taking the IWM colon QQQ. It's the IWM divided by the QQQ. Very simple. No magic there. The first chart up here is where I use a user-defined index to track it manually. Because again, stock charts is going to go from close to close. They're not going to go only from open to close. So I have to do all those computations on an Excel spreadsheet. And then I take my values and I put it into a user-defined index. And you can see we have been rallying now for 2 months in terms of the rotation that's taking place during the day. And if you just look at the IWM QQQ, which includes the gaps, we've been going mostly sideways. Ignoring the gaps, we've been rising. So it tells me during the day that rotation is taking place. Really important stuff. So let's look at those relative rotation graphs. First one I'm going to bring up is weekly. And what I've done on this chart is I've taken all of Invesco's small cap sector ETFs, and I've compared them all to the S&P 500 to see what's leading and what's lagging. Now, again, this is a longer term chart. So this is going back for the last 5 weeks, ending March 25th. And you can see most everything is going down, right? So the way the RRG works is when things are bullish, you normally see things coming out of lagging, going through, improving, and then into leading. So what you want is this northeasterly move. Instead, what we've been seeing mostly long-term has been southwesterly. Northeasterly is what we want. and we've been getting the opposite, southwesterly. Well, I will point out that small cap industrials have actually started to go back to the upside. So let me show you here. If you go and you start increasing this tail on you can see it came out of leading, went down into weakening, and now it's starting to turn back up. So see, we got down here, and if we just look at the last 3 weeks, you can see we're heading back up into the leading. And that's a lot of times what you'll see on an RRG. You go into leading, you'll weaken, and then you'll rotate right back into leading again. So this is a really good sign on small cap industrials. The other one that I would look at here would be energy, because while everything else is mostly moving in southwesterly fashion, small cap energy, even on a long-term basis, we're actually seeing the momentum pick up. That's what causes it to go higher. And then we're seeing it start to turn more to the right, which is relative strength. Now, it doesn't have relative strength until it crosses this axis. This is the vertical axis. So we still got a long way to go. We were underperforming by a mile on a relative basis, but we're starting to strengthen. Now, again, this is a long-term chart. I want to show you the daily chart, which is more short-term. And what I want to do is I'm going to go back and we'll start back at this low right here in October. This is the 5 trading days. Here we go. 5 trading days since or ending October 31st. So this is when we first started seeing some strength, right? It was the end of October. That's when this rally really started getting going. And back in, in October, in the fourth quarter, we did see some relative strength in the IWM. And I'm going to pull it up and show you. Here was the IWM starting around the second week of November through the end of the year. We had this relative strength showing up in small caps, right? Now, this was versus the QQQ, but it was similar versus the S&P 500. So when I show you this on an RRG chart, so we're going to go back. I want to take this forward until we get to that November, 14th period or somewhere around there. Okay, so this is where we were just before the middle of November. All right, so middle of November, right here. This is when we started going up around the 10th of November, here the 10th of November through the end of the year. Now watch it on a relative rotation graph, RRG. So I'm going to grab this and we're going to go, and it's just going to continue. You can watch this highlighted area right down here because this gives you the dates, the 5 days ending November 13th. So as I go and pull this, drag this to the right, it's going to show you from November 13th to December 31st how these different small cap sectors were performing. So watch this. So now I'm up to November 20th. Look at how they're all turning back up and going into the leading. They look a lot different. And if we get all the way to the end of the year, here we see some rotation. And now look at this charge back to the upside. You see how the small caps are all rotating and leading the S&P 500? That can also be seen over on this chart here, right? This is the relative strength. Then from the beginning of the year through the first part of February, small caps were underperforming again. So let's take a look at that. And we get to the end of the year, everything looks pretty good right there, right? Well, let's take a look at the next 5 weeks or so. And as I keep dragging this through, look at what happens to the small caps. Small caps continuing to drop, continuing to drop, continuing to drop. And then starting the 5 trading days ending February 2nd, again, I'll go back over to this chart. Early February, what happens? All the way till now, we've been seeing rotation into the small caps. So let's look at this rotation from early February through where we are right now and watch the rotation that takes place. Little weakness and then right back up again. Look at where we finished. We were just curling up again at the end of last week, heading higher into this leading quadrant. So this is one of the reasons why I'm pretty bullish the IWM, which is the ETF that tracks the Russell 2000 small cap index. Small caps are leading. They just are kind of breaking out to like a 5-6 month relative high. This is the time when we could see that continuing relative strength. So it's really important that you see in last week's action where that money was rotating. All right, I've got a number of stocks. We talked about that PSCI being so strong. And it finished, last week it finished very strong as well, moving up into that the strongest quadrant. So it's moving in that northeasterly fashion. And I'm going to show you why, because what I have here are components. These are all component stocks of the PSCI, which is a small cap industrial ETF at Invesco. All right, so let's get going here. AIT, look at the trend, been rolling up. These first 10 I show you are the 10 heaviest representations within the PSCI. These are the 10 most heavily represented stocks. So these are the ones, it's a pretty diversified group, but if there's any group that's going to really move the needle, it's going to be these first 10 I show you. So here's AIT, looks good. MLI, AD line going up, price action rising. AAON, AD line moving up, price action. Look at this nice little cup handle breakout above 88.50 or so, or maybe 89. That would measure up to about 98, 99, something like that. So this is one looks pretty good out of this potential cup. Next one, BCC, Boise Cascade, AD line great. Price action, you can see, just broke out within the last couple of weeks. SPXC, AD line great. Price action great. AWI, AD line awesome. Price action awesome. FSS, mostly, we've had some pullbacks in the AD line, but we definitely are trending higher. Price action looks like completion of a cup right here to me. So any kind of a pullback early in the week, that would look pretty interesting. Anticipating a breakout. Breakout on this one would measure probably up about another $8 to about 93. So pull back to about 82 and a half if we get one, could lead to about a $10 gain in the stock based on the way it's set up. ALK, Alaska Air Group, AD line was consolidating, just broke out last week. Look at the tops coming across here, 40, 41, multiple tops. Went to 43, 42.99 was Friday's close, breaking out and doing so with volume picking up. Number 9 stock in this group, MOG/A, Moog Inc. AD line right near the top, strong stock. FELE, AD line strong stock. This is why the PSCI is performing as well as it is, because we're seeing a lot of these small cap component stocks really looking much stronger than they have in many, many, many months. So great action in this small cap area. Still have a few more stocks I'll go through real quick. These are 6 others I just thought were worth mentioning. This is Encore Wire, AD line just going straight up. We had kind of like this, almost like a W, certainly a double top. I don't know if that's a cup, kind of a weird thing here in the middle, but it kind of acts like a cup. Sideways action, and then boom, breakout there. Volume started to pick up a little bit. Next up, KFY. Big move up. I'm pretty sure that was with earnings. Volume picked up. It wasn't huge, though. But anyway, it looks to me like we're going to go back up and establish the right side of a cup off an uptrend. That AD line remains strong. AVAV, this was a crazy one because it made such a huge move with earnings. Ended up going all the way back down and hitting this prior high. I think it's now starting to turn back up again. Wouldn't be shocked to see it all the way back up at 185. AD line on this one's a little suspect, so I'd keep an eye on that. And maybe just watch the recent low, make sure that holds. But otherwise, this one looks like it's poised for further movement to the upside. Enpro Industries, NPO, just made a breakout. AD line strong. GFF, this is one of our portfolio stocks at EarningsBeats. I think it's in our aggressive portfolio. But anyway, great looking stock, just keeps going higher. AD line strong. Last one I have for you is ESE. This is one that had been downtrending for a little while, but notice it broke above the moving averages. It held the moving averages and then broke to another high. That's the signal of an uptrend. And I love this AD line breaking back out to highs. So that's just a lot of stocks that I wanted to go over and talk to you about in the small cap area, and then also a number of stocks that we looked at in the transports. A couple more things that we want to get through, though, before we wrap this thing up. And I know I'm running just a little longer than I wanted, but let's take a look at companies that reported earnings last week. 3 of them I want you to be aware of. McCormick, big gap up. I know this is more of a staples kind of a stock, but after downtrending for a while, and by the way, look at gap resistance. We gapped down on heavy volume. I'm sure that was earnings related there. Big move down. Look at the failure every time we get up near that $70 level. Failure, 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 failure. Earnings come out. We gap up not only above the bottom of the gap resistance, but also above the top of gap resistance. I think MKC is now starting an uptrend. Next up, CTAS, great report, big gap up. Did pull back a little bit off that intraday high after earnings. Volume very strong, though. I think you're going to find support just below that 660 level on any selling. VRNT Systems, VRNT, big gap up. This stock, with its earnings report, which was strong, cleared all these prior highs. I think any kind of a pullback down near 31 would be viable. Next, raised guidance from last week. A few charts I want to show you here. GDS, now, first thing I'm going to say is this is not a great looking chart, but after it reported earnings and it raised guidance, we saw a move down from 9 to 6, held this support area, and now starting to turn back to the upside. I think as long as we put in higher highs, higher lows, I think this is one that might go up in the short term. I wouldn't be holding it for very long, though, because, again, overall, this move to the downside has me a little worried. NCNO raised guidance, a gap up, went right through resistance. I think any kind of a pullback down to the 34, 35 area would represent good entry. OUST, OUST, raised guidance. Stock went from $5 to $8 in 2 days. Now, it is a very small stock. Again, trading only down at finished at 794 last week. Volume prior to these last 2 days, generally below 1 million shares. So it's not huge in terms of liquidity, but it is above $5 and it does average over 250,000 shares. Wanted to mention it. It's getting close to resistance. I would not be getting in here. I'd either need to see the breakout or maybe get some kind of a pullback. CTAS, already mentioned that one, so I won't go over it again here. But in addition to beating earnings estimates, they also raised guidance. RH, big gap up above this key area of resistance here near 310, 320. Did it on heavy volume. Anything back down near 330 would be an interesting entry point. There's VRNT, which also I talked about with earnings. They also raised guidance. Looked pretty good there. Last stock I have for you today, WBA, Walgreens Boots Alliance. Been downtrending, but that PPO is starting to turn up. And with earnings, we actually saw raised guidance, and WBA went up, closed above its 50-day moving average for the first time in nearly 3 months. So WBA, maybe it's going to have the start of an uptrend. It is down near some longer-term price support. Anyway, that is it for this week's market recap. Really appreciate you tuning in. Again, please hit that like button. Subscribe to the channel. That'll really help us. And if you'd like to join me on Monday at 4:30 for Candlestick session, all you have to do is go over to EarningsBeats.com and click on that link and get yourself signed up. We'd love to see you. Have a great rest of your weekend. Happy Easter to everyone, and happy trading.